Gold and silver are not just rising. They are re-exploding to all-time highs in a way the modern financial system has never witnessed. Gold has ripped past $4,600 an ounce, while silver has shattered history, blasting above $90 for the first time ever. But here's the real shockwave. And this rally isn't driven by retail hype. Central banks are quietly hoarding gold, dumping trust in paper money. Is this panic, or the smartest move of the decade? Before we go any further, hit like and subscribe if you want real market data. Not noise, not hype, just the numbers that actually move global wealth. And I want to hear from you. Where do you think gold tops out? Is this run heading toward $5,000, $10,000, or something even bigger? Drop your call in the comments below. Gold and silver have always been the world ES ultimate safe havens. But what S happening now is fundamentally different. These metals are no longer just insurance for crises. They're being treated as core reserve assets, quietly replacing trust in paper currencies. Across Asia and emerging economies, central banks are buying gold at a pace never seen before, reshaping global supply, demand, and pricing power. At the same time, institutional money is flooding in. ETFs are absorbing billions as investors lose confidence in bonds, question equity valuations, and brace for the next phase of monetary instability. This shift isn't emotional, it's strategic. It's not driven by fear alone, it's driven by calculation. This isn't theory, this isn't speculation, this is happening right now, and it's rewriting the rules of global finance. What makes this moment historic isn't just that gold and silver are rising, it is how fast and how far they be moved in an incredibly short window of time. As of early 2026, gold has surged beyond $4,600 per ounce, carving out fresh all-time highs and leaving behind decades of price ceilings that once seemed unbreakable. This isn't a slow grind higher. This is an acceleration phase, the kind markets enter when confidence in traditional systems begins to crack. But silver may be telling an even louder story. Silver has exploded into the $88 to $92 range, shattering every historical reference point. For the first time ever, silver has decisively moved above $90, not on speculation alone, but on tightening supply, industrial demand, and capital rotation into hard assets. Now compare this to where we were just 1 year ago. At the start of 2025, gold was trading near $20,600 an ounce. Silver hovered around $28. That means gold has climbed nearly 80% in barely 12 months, while silver has delivered gains that border on exponential. This kind of move doesn't happen in healthy, stable monetary environments. It happens when investors and institutions begin to question the foundations beneath stocks, bonds, and currencies. Prices don't move like this without a reason, and the reason lies deeper than charts. It lies in who is buying, why they're buying, and what they're preparing for next. What we are witnessing right now isn't a sudden reaction. It is the culmination of a long-running strategy that most people simply weren't paying attention to. For years, central banks have been quietly accumulating gold, but over the past 12-18 months, that buying has accelerated beyond expectations. This isn't retail speculation. These are sovereign institutions, the most conservative players in global finance, making deliberate structural shifts in how they store national wealth. At the core of this move is a simple truth. Trust in the old reserve system is eroding. Traditionally, central banks parked the majority of their reserves in US dollars, euro-denominated assets, and government bonds, especially US treasuries. But persistent inflation, rising debt loads, and the weaponization of currencies through sanctions have fundamentally changed the risk calculus. Paper assets now carry political risk, currency risk, and inflation risk all at once. Gold solves a problem no fiat asset can. It has no counterparty risk. It cannot be frozen. It cannot be printed. That's why central banks aren't trading gold. They're stockpiling it. This buying didn't begin in a crisis moment. It began years ago as part of reserve diversification, and it has continued uninterrupted. Instead of relying on a single dominant currency, central banks are spreading risk across tangible, politically neutral assets. Gold sits at the top of that list. China is the clearest example. For over a year, China has consistently added gold to its official reserves, month after month, without dramatic announcements. The steady accumulation signals intent, not emotion. China isn't chasing price, it's building insulation against inflation, against dollar volatility, against geopolitical pressure, and China isn't alone. Across Asia, the Middle East, and parts of Eastern Europe, central banks are increasing gold allocations as a hedge against three major threats: currency debasement, financial sanctions, and global instability. In a world where reserves can be frozen with the stroke of a pen, physical gold offers something no digital ledger or bond certificate ever will: sovereignty. This is why the question isn't, are central banks panicking? It's, what do they see coming that others don't? because central banks done a T-buy at record levels unless they believe the existing system is becoming structurally weaker. They don't allocate billions to a non-yielding asset unless the alternatives feel riskier. Gold is no longer being treated as a backup. It's being treated as monetary insurance. And here's the most important part. Central bank gold rarely comes back to the market. Once it's added to reserves, it's effectively removed from circulating supply. That creates a tightening effect that compounds over time, quietly pushing prices higher long before the public understands why. So when you see gold breaking records, don't think speculation. Think strategy. Think long-term positioning by institutions whose job is not to guess, but to survive. While central banks are locking gold away in vaults, institutional investors are attacking the market from a different angle, through ETFs, futures, and large-scale capital allocations that move prices fast. In 2025, gold ETFs experienced record-breaking inflows of roughly $89 billion, the largest annual surge ever recorded. This wasn't a trickle of defensive buying, it was a flood. Pension funds, asset managers, sovereign wealth funds, and insurance portfolios all began repositioning at the same time, searching for stability in a world where bonds no longer provide safety and equities feel increasingly fragile. As a result, global gold ETF holdings have now climbed beyond 4,000 tons, an all-time high. To put that into perspective, that's more gold than most central banks hold individually. And unlike short-term traders, institutional ETF flows tend to be sticky. Once allocated, capital doesn't exit quickly unless the macro picture dramatically improves. What's driving this shift is not fear, it's math. Real yields remain under pressure. Government debt continues to balloon, equity valuations are stretched. In that environment, gold's lack of yield becomes irrelevant when everything else carries hidden risk. Institutions aren't chasing returns here. They're protecting purchasing power. Silver, however, is attracting a slightly different kind of institutional interest, and that S, what makes its move even more explosive. Unlike gold, silver is both a monetary metal and an industrial metal. It's critical for solar panels, electric vehicles, advanced electronics, and energy infrastructure. As investors rotate toward assets tied to real-world demand, silver has become a bridge between hard asset protection and industrial growth. Institutional flows into silver have surged as funds look for leverage to the metal cycle. While exact numbers vary across ETFs and derivatives markets, the underlying driver is clear: supply is not keeping up with demand. Years of underinvestment in mining have left the market structurally tight, and that imbalance becomes painfully visible when large pools of capital move in at once. This is why silver has been outperforming gold so dramatically. When institutions pile into a market with limited supply, prices don't rise gradually. They gap higher. And unlike speculative retail rallies, institutional positioning tends to build over quarters, not weeks. Together, ETF inflows and institutional demand are creating a powerful feedback loop. Higher prices validate allocations, which attract more capital, which further tightens supply. This isn't a bubble forming overnight. It is big money repositioning. For a world where financial safety looks very different than it did just a few years ago, to understand why gold and silver are surging right now, you have to step back from price charts and look at the global pressure points hitting the financial system all at once. This rally isn't driven by a single trigger. It's the convergence of geopolitics, monetary policy, and capital rotation. Start with geopolitics. The world is more fragmented than it has been in decades. Wars, trade disputes, and economic sanctions have turned currencies into tools of power. When reserves can be frozen, payments blocked, and trade weaponized, confidence in fiat systems erodes. Every new conflict, every new sanction adds stress to currencies, and stress sends capital toward assets that exist outside political control. Gold and silver thrive in exactly this environment because they carry no allegiance and no counterparty risk. Next comes inflation and interest rates. Even as headline inflation cools in some regions, the damage has already been done. Purchasing power has been permanently reduced, and debt levels have exploded. Markets are now pricing in future rate cuts, not because economies are strong, but because they're fragile. When rate cuts approach, real yields fall. And that's the key variable for precious metals. Gold doesn't compete with high real yields. It dominates when real yields turn negative or unstable. As investors anticipate easier monetary policy, they move early, straight into hard assets. Then there's the US dollar. For years, a strong dollar suppressed precious metals, but as debt expands and fiscal pressures rise, the dollar's dominance is being quietly questioned. Even modest dollar weakness can have an outsized impact on gold and silver prices, because metals are globally priced in dollars. When confidence in the dollar slips, metals don't just rise, they reprice. At the same time, risk assets are faltering. Equities face stretched valuations, slowing earnings growth, and rising volatility. Bonds, once the ultimate safe haven, have failed to protect portfolios during inflation shocks. The traditional 60-40 portfolio no longer behaves as expected, and that forces institutional investors to look elsewhere. This is where precious metals step in. Gold and silver outperform when risk assets weaken because they sit outside the credit system. They don't depend on corporate profits, government solvency, or central bank credibility. When stocks wobble and bonds lose their defensive role, metals become the only asset class that benefits from uncertainty itself. In moments like this, capital doesn't ask where returns are highest. It asks where risk is lowest. And, historically, when the answer to that question shifts, gold and silver don't move slowly, and they surge. Now comes the question everyone is asking: how far can this really go? And more importantly, what do the institutions that shape global capital flows think happens next? Across Wall Street and global research desks, the tone has shifted dramatically. This is no longer a debate about whether gold belongs in portfolios. It was a debate about how high the repricing could extend if current conditions persist. One of the most closely watched forecasts comes from JP Morgan, which now sees a base case pathway toward $5,000 gold by late 2026. What's important here is the wording, base case. This projection assumes no financial crisis, no systemic collapse, just a continuation of current trends. Persistent central bank buying, softer real yields, and ongoing diversification away from fiat reserves. Other banks go further. Under more aggressive scenarios, where rate cuts accelerate, geopolitical tensions worsen, and history supports this logic. Gold tends to move in long consolidation phases, followed by sharp repricing cycles. The current breakout suggests we may be in the early to middle stages of such a cycle, not the end. That's why analysts are focusing less on short-term pullbacks and more on structural demand, especially from central banks and long-term institutions that don't trade in and out. Silver, however, is where forecasts become even more intriguing. Unlike gold, silver's outlook is split between two powerful forces: monetary demand and industrial demand. Some analysts remain cautious, pointing to volatility and the metal's tendency for sharp corrections. But a growing number argue that continued supply deficits change the equation entirely. If industrial demand from renewable energy, electronics, and infrastructure continues to expand, while mining supply struggles to keep up, silver's upside remains open-ended. In that scenario, silver doesn't simply follow gold higher, it outperforms, as it has already begun to do. This is why forecasts for silver vary so widely. The range reflects uncertainty, but also potential. In tight markets, prices don't respond linearly. They respond explosively once thresholds are crossed. What unites these forecasts isn't blind optimism, it's a shared assumption. The old playbook for money is changing. When confidence in fiat systems weakens and real assets regain prominence, gold and silver don't just hedge risk, they redefine value. The message from analysts is clear. The rally may pause, it may correct, but the broader trend is not finished. If anything, they argue, the most important moves may still lie ahead. While gold and silver are grabbing headlines with historic rallies, it's crucial to remember, nothing in financial markets moves in a straight line. The soaring numbers we've discussed come with real risks, and understanding them is essential before committing capital or assuming the trend is unstoppable. First, there's volatility. Precious metals are inherently cyclical. Even during long-term uptrends, prices can experience sudden pullbacks of 5 to 10%, sometimes more, in a matter of days. These aren't signs that the rally is over. They're natural pauses as the market digests flows, reallocates capital, or reacts to short-term news. Investors who aren't prepared for these swings often panic, selling into weakness and missing the broader trend. Next, consider index rebalancing events. Large ETFs, commodity funds, and institutional portfolios periodically adjust their holdings to match new weights. For gold, silver, and other metals, these events can temporarily flood the market with supply, putting downward pressure on prices even as underlying demand remains strong. For example, if a major gold ETF needs to trim allocations after a surge, the short-term sell-off can spook retail traders who interpret it as a trend reversal. Then there's the question of speculative froth. Not every dollar moving into metals is driven by fundamentals like central bank buying, industrial demand, or long-term hedging. A significant portion of the recent spike comes from fear of missing out, FOMO, retail traders, and short-term funds piling in simply because they see prices rising. Speculative flows can accelerate rallies but also amplify corrections, creating sharp emotional swings that diverge from intrinsic value. It's also important to recognize liquidity risk. While gold is highly liquid, silver is smaller and more volatile. In thin markets, large trades can move prices disproportionately, and leveraged products can magnify gains or losses rapidly. Investors who fail to account for this risk may overestimate their ability to ride a trend safely. Finally, macroeconomic shifts can alter the outlook quickly. A sudden recovery in equities, an unexpected rate hike, or a major geopolitical de-escalation can reduce demand for safe haven assets and trigger sharp reversals. Metals are sensitive not just to supply and industrial demand, but also to market sentiment and global monetary policy. In short, while the long-term trend for gold and silver may be bullish, the path is anything but smooth. Prices can and will retrace. Temporary drops, sudden surges, and short-term panic are part of the game. Those who understand this volatility and who separate fundamental strength from hype are the ones who can navigate the metals market intelligently. The lesson here is simple. Never mistake a strong rally for invincibility. Precious metals offer protection, but they're not immune to swings, corrections, or speculative excess. Awareness of these risks allows investors to ride the wave with strategy, not emotion. The market rewards patience and prudence, not blind optimism. As we wrap up, it's important to step back and see the bigger picture. These record-breaking prices aren't random or speculative. They reflect a deep structural shift in global finance. Central banks are quietly hoarding gold as a strategic reserve, while institutional investors pour billions into ETFs and industrial metals. This combination of official and private demand is reshaping supply and pushing prices to levels we haven't seen in decades. Analysts are watching closely, and the consensus is clear. The upside isn't finished. JP Morgan and other major banks see gold potentially exceeding $5,000 per ounce by late 2026, while silver's performance could continue to outpace gold if industrial demand remains strong and supply tight. These metals are no longer just safe havens. They are core assets in a world where fiat currency and traditional financial instruments face unprecedented pressures. That said, this isn't a risk-free environment. Precious metals remain volatile, and sharp corrections can occur, often triggered by ETF rebalancing, speculative swings, or sudden macroeconomic shifts. Investors need to be aware that while the long-term trend may be bullish, short-term swings are inevitable. Those who treat gold and silver as a strategic allocation rather than a get-rich-quick bet are far more likely to benefit from this historic rally. In essence, the story of gold and silver today is a tale of structural demand meeting limited supply, amplified by geopolitical uncertainty, monetary shifts, and investor psychology. For those paying attention, this isn't just a market trend. It has a fundamental rethinking of how wealth is preserved and risk is managed globally. Record highs are just the beginning. But navigating this landscape wisely requires patience, awareness of risks, and an understanding of the forces driving this historic surge. Gold and silver aren't just shining, they were signaling a seismic shift in the world of money. Before we close, here's where you come in. What do you think? Will gold reach $5,000 this year, or are we looking at a temporary peak? Your perspective matters because this rally isn't just numbers on a chart. It is a global story unfolding in real time, and every investor, trader, and observer has a unique take. Drop your thoughts in the comments below. Tell us your target price for gold. Share whether you're more bullish on silver, or maybe you see the risks we discussed playing out first. Engage, debate, and join the conversation. Your insight could help someone else see the bigger picture. And don't forget to subscribe. Markets move fast, and central bank actions, ETF flows, and geopolitical developments are reshaping gold and silver prices constantly. When the next wave of data hits, when new central bank purchases are revealed or metals hit new highs, you all want to be first to know. That's exactly what this channel delivers. Clear, factual updates without hype, so you can make informed decisions in real time. If you found value in this breakdown, the data, the forecasts, and the risks, subscribing ensures you don't miss the next update. We'll analyze the next surge, track institutional and central bank flows, and give you the context you need to understand why prices move the way they do. So, take a moment, comment your predictions, hit that like button, and subscribe. The metals market is moving fast, and the next big story could happen tomorrow. Be part of the conversation, stay ahead of the trends, and position yourself to see the next chapter in gold and silver's historic rally. Gold and silver are signaling a seismic shift in the global financial system. Don't just watch it happen. Be part of it.